The US and Israel began joint air attacks on Iran on February 28th. Equity markets have been resilient. The S&P 500 ended the first week of the conflict down just 2%. But a more detailed look at the markets tells a different story. I'm John Cervantes. This is the Practitioner's Brief. And today we're talking about the Iran war and what history says about military conflict and how it impacts equity markets, and what I'm watching to determine if the energy supply disruption is a long-term or short-term problem. The broadening trend continued in early 2026. International equities, US small caps, and the average stock. But they all underperformed the first week of the conflict. Investors are grappling with the duration, scope, intensity of the conflict. The rotation is not dead, but it is on pause. And history shows the average stock market gains after geopolitical conflicts, but the outcome ranges are very broad. 20% of global oil supply transits the Strait of Hormuz, and as of March 6, the crude oil curve is in steep backwardation. Longer dated contracts trading well below today's spot price, indicating a quick resolution. And so this timeline is what we need to watch, and it's what we're going to discuss today. So what does history say about investing through war? Most of what you're reading in financial media right now points to averages. The New York Times highlighted research citing the average stock market gain 1 year after U.S. military conflicts that last more than 1 day is 12.5% going back to Operation Desert Storm. CNBC cited the Stock Traders Almanac. The average gain 12 months after the start of a global conflict is 2.9% since World War II. That's all fine. It's factually correct. Here's what it misses. Averages obscure the range of outcomes and the current market dynamics. For example, the U.S. invades Afghanistan in October 2001. The market's down 26.7% a year later. Was that the war? Or was it a continued unwind of the technology bubble that burst the prior year? You can't cleanly separate the two. The range across major geopolitical crises runs from negative 34% after the 1973 Arab oil embargo to a positive 32% after the Gaza war in October 2023. That's a massive spread. Telling someone the average is 2.9% is technically true and practically useless. The variable that's going to separate this outcome from a good one from a catastrophic one is whether the conflict produces a durable energy supply shock. That's it. That's the variable. That's what makes this conflict fundamentally different from Afghanistan, from Libya, or Kosovo. So here's why the do-nothing playbook carries a little bit more risk this time. Every cycle, the consensus advice during a geopolitical shock is the same. Do nothing. Stay the course. And that's usually correct. The market has an upward bias. But there's 4 conditions that are converging right now that make the do-nothing playbook riskier than usual. First, valuations and concentration. As I wrote in February, the S&P 500 sits at historical high valuations with unique technology concentration risk. The market isn't priced for disruption. It's priced for perfection. And a major military conflict can quickly change the multiple the market is willing to pay. Second, energy is still structurally under-owned. Energy equities carry an insignificant weight in the S&P 500 at 3.5%. Even less than that for the NASDAQ at less than 1%. Most portfolios have minimal direct exposure to the sector that benefits most from this exact scenario. I wrote about this in June of 2025 as the Israel-Iran conflict first began. Third, the Fed is going to be flying blind. Rising energy prices make rate cuts incrementally harder. We went into the conflict with the market expecting a couple of rate cuts this year. That expectation, in my opinion, fueled some of the broadening of the stock market performance. Small caps, cyclicals, rate-sensitive sectors. If oil-driven inflation kills the rate cut path, the very rotation I've been looking for stalls. On top of that, mortgage rates are already back above 6%. The 10 years back above 4%. And fourth, it's China. You can't remove China from this equation. China buys 80% of Iranian oil at steep discounts. They've committed $400 billion in a 25-year strategic partnership. They built Iran's surveillance network. They were planning to replenish Iran's ballistic missile stockpile. Some analysts argue that the Iran strike is about severing the China-Iran relationship more than it's about regime change. The strategic logic being tie the U.S. up in the Middle East, reduce capacity for a response in Taiwan. For investors, this reframes the entire trade. It's not just about barrel supply. It's about what happens to China's discounted crude access. What does it mean for US-China relations, for Taiwan, and for the trade war? And these are not short-term risk. So, assuming you haven't already adopted my mantra of managing risk before it's present, and if you're watching, this may be time to start. Let's walk through 3 obvious knee-jerk reactions, and I'll provide some perspectives. Reaction 1, buy energy equities. Remember that the market is a discounting mechanism. Energy equities measured by the XLE are up 26% year to date through March 6, with the bulk of those gains coming before the conflict began. Military assets were moving into the region. Energy equities were climbing. That is not a coincidence. And here's a data point that tells you the most. The crude oil curve is in steep backwardation, with longer dated contracts trading well below today's spot price. This gap is a market telling you in real time that it views this as a short-term disruption, not a durable supply shock. Buying energy stock today requires you to take the other side of that bet. You have to believe the market is wrong about the duration of the conflict. Maybe it is, but you have to know why you're buying. You also have to think about a positive outcome. A more US-friendly Iran and Venezuela mean long-term supply. Lower prices, not necessarily great for energy equities. Reaction 2, reduce equity exposure. The S&P 500 is about 3.5% from its all-time high. While I'm not a fan of reacting to volatility, but if this conflict is causing you financial worry, reviewing your equity exposure right now is a reasonable move. The where and how to reduce matter, so get professional guidance. Reaction 3, buy the dip. For net savers, this is a time to get organized. Outline your cash demands over the next 12 to 18 months. Make sure your financial house is in order, and prepare to surplus to be an investor. Last week slowed down the market rotation into smaller, cyclical, non-AI disruptible businesses. That rotation isn't dead, it's on pause. And for me, that's where the greatest opportunities live. So what am I watching to determine if this is a short-term or long-term conflict? There's 5 things. 1, the XLE versus the S&P 500 on a relative basis. If energy starts outperforming again from here, the market is repricing the duration of the conflict. 2, the Brent forward curve. I like to watch the longer dated 6 and 12-month contracts. If backwardation steepens, if the front end of the curve keeps pulling away from the back, that's fear. If it flattens, the market is digesting this shock. 3, Cheniere Energy, ticker LNG. They're their largest U.S. liquefied natural gas exporter. Their stock price tells me how the market is pricing the European and Asian gas import disruption in real time. It's not a perfect representation, but it works for me. 4, Japan and European equity markets. They're big energy import dependent markets. If they stabilize relative to the US, the global contagion risk is fading. If not, there's more risk on the horizon. 5, interest rates. If oil-driven inflation pushes rate cut expectations off the table, the broadening trade's getting pushed out further. A rising 10-year also shows concerns about long-term inflation expectations. And plus, war is expensive and the US isn't exactly in a strong fiscal position. But as of March 6, 2026, the market remains resilient. This is a bull market. Act accordingly. But acting accordingly doesn't mean acting blindly. Understand your risk exposure. Understand what the forward curve in oil is telling you. And remember, the biggest risk to your portfolio isn't geopolitical conflict. It's yourself. The average investor tends to make ill-timed decisions. I'm John Cervantes. This is a practitioner's brief. If you need some help, reach out. I'll see you soon.